Okay. So next week, got a marathon session, 6 hours. Come for the whole lot, please. Actually, it would be good if you could, because you'll learn a bit, but of course you don't have to. So we'll start at 3 p.m, different location, Rupert Myers Theatre. So we'll start at 3 p.m, and we'll just keep going till everything's done. So basically, I've got online, I've got the groups. That is the order in which you'll present. So the groups, in terms of your group number there, is the order in which you'll present. So 1 to 15, I think there's 15 groups. Okay, so obviously these ones will be the first up around 3 o'clock. So basically, if you're not staying for the whole lot, groups 1 to 5, can you make sure you're there at 3 o'clock? So groups 1 to 5, please come at 3. Groups 6 to 10, if you're not already there at 3, come by 4:45. And then groups 11 to 15 by 6:30. But if you could just look into the theatre and not walk in while people are doing their presentations. Okay, and also you can leave. Once you've finished, it's fine to leave. But again, either leave immediately as soon as yours is finished, or wait for the next one, the next gap before you leave. Okay, I don't want people walking in and out while people are presenting. All right, so any questions there? Okay, and tell me if there's any problems in your group. There have been one or two that have told me there's problems. So we're trying to ensure that everyone contributes equally. Okay, it's important. Forget about this presentation. If you're the type of person that doesn't feel guilty when you're not contributing equally, it's not a good indication of what's going to happen in the coming years. Okay? I personally feel guilty if I'm not contributing equally. And if you haven't got that kind of work ethic, I strongly recommend you develop it. Okay. So, quick lecture today. There are a lot of slides, but probably core content is less than other lectures so that we can get through the two very good one very good case study and a proxy fight. But the ITT case is a very comprehensive case study. So we want to spend a bit of time on that. The case studies so far are very good. You've done a good job on those. So you'll get those marks by the end of this week. And there was one student that hasn't completed one so far, meaning they cannot complete all three by today. That student that I sent an email to, please see me if you're here, and we can discuss it. Okay? But everyone else has handed in at least one. Okay, so today's three subjects. We're going to look at restructuring, which is basically exit. LBOs, although we did a lot of that last week in the iLab, so we won't have to spend too much time on that part of LBOs, valuation, and then we'll quickly finish up on cross-border. Okay? So, restructurings is quite a broad word, but basically, as we refer to it in this course, it's basically exits. Okay? So we have asset restructuring, which is sales or divestments, merging divisions, which is an operational change, which isn't part of this course. How could you, basically the first question here is when we're restructuring, what kind of restructurings do we have? We can restructure our assets, we can restructure our ownership of those assets, and we can restructure our liabilities. So assets, we're going to focus on that, in particular divestments or sales. Operationally, you can restructure your assets by merging divisions. That's obviously not an M&A transaction and outside the scope of this course. Or you can add division, which is of course acquisitions, which we've covered for most of this course, how we go about acquiring assets. Equity ownership restructurings, we're going to look at those, changing the ownership structure of either the parent or divisions. We're going to look at these types of equity ownership restructurings. And finally, very briefly, we're going to look at liability restructurings, which are about changing the balance sheet. Okay, this is about changing ownership, this is about changing the balance sheet, how we actually own our current assets. So we'll look at that briefly as well. Because all of these can be either responses or actual M&A transactions. Or responses, they could also be defence. Those of you who did ITT Hilton would know that liability restructuring can be a defence as well. So we'll talk about that. Now the first point, actually many of these restructurings, before we get to that, I just want to get our terminology right. So let's do the first question. Have you heard of these terms? Divestments, carve-outs. Don't worry if you haven't, because you're going to learn them now. But basically, what do you take them to mean if you haven't heard of them? I think I've already said this answer, but Just check if you're listening. Sorry? Okay? Of course that is true. All of these are exits, all right? The word divestment strictly means exit, but all of these are forms of selling off assets. So up until now we've talked about mergers and acquisitions. Part of mergers and acquisitions, even though the title doesn't necessarily state it, is exits. Okay, about a third of M&A transactions are exits. Okay, someone exiting an asset. So they're a significant part of what you do. So if you're an investment banker, you'll probably do almost as much sell-side advisory, where you're advising the seller how to go about selling the asset, maximising the value of the sale, as much as you'd be doing buy-side. Okay, so sell-side gets close to being half your work as an investment banker. So it's a significant part of what we do. Not that this is an investment banking course, but just to show you the volume of transactions. Now, most exits occur as an unwind of previous M&A. So an unwind of a previous transaction. Okay? And that is especially the case because to this day you have many companies having legacy assets, okay, where they still have assets for whatever reason that they've acquired over the years that no longer fit within the company structure. And markets really don't like that today. And there's been a number of studies on this. Many studies suggest that companies that remain as conglomerates, okay, the results aren't uniform here, but let's just say roughly they point towards a diversification discount. Meaning the sum of the parts is greater than the whole. If you split those companies up, they're worth more than they're worth grouped together. And the discount of the whole being less than the sum of the parts, the range of this empirical analysis is somewhere between 8 and 15%. Okay, there's been many studies. Some say there's no diversification discount. The majority says there are. Now that's where you have assets that don't logically fit together. If they obviously are synergistic and fit together, then that doesn't exist. So you have to also, in this empirical analysis, be confident with the author's decision on what is a core asset and what's a non-core asset. Okay, so, but there's many studies on this, and the literature does suggest that there's a diversification discount. That is because the benefits of conglomeration or matching assets that aren't necessarily fitting together or don't have synergies are less than the costs. Okay, some of the benefits are you have common headquarters, so obviously that's a synergy. Internal capital market is more efficient than the external capital market, so this is the Berkshire Hathaway view that Warren Buffett can allocate money between his businesses more effectively than the capital markets can, or raising equity raising from the capital markets. So he believes that's an important synergy of grouping unrelated companies together. Okay? Now that's Warren Buffett. Not all companies can beat the external capital markets in allocating capital. Potentially you can have a more aggressive capital structure. Banks will sometimes lend against higher amounts against larger, more diversified companies than smaller companies. Okay, so potentially there's some financing benefits. I've talked about this before, exporting or leverage management capabilities. So that was the GE philosophy in the 70s and 80s. We're the best managers in the world, so why don't we fit unrelated businesses together, and what's our synergy? Our management. We're bringing them all under the umbrella of our management, and therefore they don't have to necessarily be synergistic. We just know we'll manage them better than anybody else. So that was their theory. Unfortunately, GE's value today is less than it was in the 70s and 80s. So obviously, when that management team left, Jack Welch and those guys left, you can sort of see what's happened since. Tax advantages would be another reason for conglomeration, offsetting the losses of some business against the taxable gains of other businesses. Okay, what are the costs? Often it's the fact that the management team don't have the skills to manage so many different sectors. Okay, you have a manager that's come up through the core sort of company focus, and then they're expected to be CEO or head or CFO even, is still difficult, of a company that's unrelated to the core operations. So sometimes they don't have the management ability. There's what we call the twin agency problem. So agency problems result between conflicts between shareholders and either the board or the management. Now you have a potential additional layer of agency problems between the top management and the individual division heads. Maybe the individual division heads are not representing the overall aims of the management. So that's often called the twin agency problem. Cross-subsidisation and politics are evident. There's a lot of evidence of wastage in conglomerated companies. It's often the fact that companies are conglomerates because of history, and they never really fit together anyway. So it was either some previous transaction exhibiting empire building or management hubris. In other words, the business never really made sense and was probably overpaid for. Opportunity cost of not giving it to the most logical buyer. So I have a bunch of businesses together, and there's industries that specialise in each of those businesses. They'd probably be able to pay me more than I could extract value under my umbrella. Okay? So it's the opportunity cost of potential greater synergies. And as I've said to you many times before, today the shareholder says, don't you diversify, we'll diversify. So you be a specialist, you focus on your core operations, and we'll own a little bit of you and a little bit of this and a little bit of that. We'll put our own diversification in place. Okay? So the net result of the empirical analysis is that the costs outweigh the benefits. Yes. Diversification is value destroying, not enhancing. Certainly the share markets respond negatively to diversification these days. Now I'm talking about unrelated diversification, of course, right? But the word conglomerate means fitting together unrelated businesses. Diversification by expanding into a new country in your core line, that's well liked. Or a logical product extension of your core business, that's well liked in the markets. I'm talking about, when we talk about conglomerates, we're talking about unrelated businesses being under the one corporate umbrella. Okay, so the share market doesn't like it, performance decline. Research shows conglomerates often reverse the strategy, and when they do, the divestiture has a positive effect on their share price. Okay, the larger the divestiture, the bigger the share price impact, positive. The divestment of unrelated non-core businesses results in a large share price increase, and assets sold having a strategic fit with the buyer. In other words, this idea of opportunity cost, where you're unloading assets that don't fit well under your umbrella to the most logical owner, where the asset has a strategic fit with the new owner, the share price impact is larger, when it, positively larger. Okay, so that's the empirical analysis.
For the buyer?
For the seller. When the buyer is a strategic buyer of a seller who's a conglomerate with unrelated businesses, the share price impact is greater. It's the idea of sell the asset to the most logical owner. Okay. Why do these restructurings occur? As I said, they're generally an unwinding of previous M&A. Now, what are the motives for this? Why would you sell? The most common one is, and if you read the press release of most companies when they're talking about exits or restructuring, the first paragraph would say something like, refocus on our core operations. You read it all the time, refocus on our core operations. This is this point, sharpen strategic focus, dismantling inefficient conglomerate structures, remove distractions so they increase focus on the core operation, exploit management expertise in specific industries, meaning we're only going to focus on what we're good at, okay? Now this is a feature since the 90s. In the 80s, shareholders were happy for their management to go out and diversify. From about the 90s, shareholders like focus, okay? Specialisation and focus. My point being, this wasn't a permanent feature of the markets. And in the 60s and 70s, actually, your share price used to go up the more you were doing these kinds of diversifying deals. Okay, they were trendy and the market responded quite positively, but the evidence started to come in the 80s and 90s that the focus companies outperformed the conglomerates. Okay? And that became a clear market evidence that this strategy in the 60s of diversifying was not working. What's another rationale? Reversing previous poor M&A, exit valuing, destroying M&A. Okay, very common motive of exits. Overvaluation, over-optimistic synergies, cost reductions, underestimation of integration costs, stakeholder resistance. All of these underestimated aspects, exit unattractive or highly competitive business dynamics. Okay? Now often, if you're the advisor that advised them into the transaction, you're not going to get the advisory out of the transaction because they blame you for that. Okay, but there were advisors out there that sometimes would get the transaction in and the transaction out. Obviously, if you're a trusted advisor and working well with your clients, you know, you're trying to think like them and not encourage them to do value-destroying M&A, okay? And therefore, you'll never get the exit because the M&A you do should enhance value permanently. This is the next one. This is sometimes a good reason. So these are sort of reasons indicating that the previous structure was not ideal or was destroying value. Sometimes the reason can be positive, as in it's a growth business that they started from scratch often and they've decided to spin it out to get value for it because it wasn't valued correctly by the markets within the structure. So there's many examples of that, like internet companies. Realestate.com was spun out of News Corp. Domain, the property internet site, was spun out of Fairfax. So what the view there was, old media like newspapers like Fairfax and News Corp. Okay, within that umbrella of a declining revenue, nobody's reading papers anymore. Okay, so advertising is split in half, or actually a third of what it used to be in newspapers. So old media is declining. Within these old media companies, they set up these great businesses like Domain or Realestate.com, where you have your property internet sites. So they spun them off because within the old structure, the market wasn't seeing their true worth. Okay, and they spun them off, and now those businesses like Domain, Realestate.com are worth multiples of what they were when they're under the old structure of old media. So often exits are done to unlock hidden value by increasing transparency of underappreciated assets, particularly internet type assets recently in media has been a big example of that. Eliminate the diversification discount by basically saying, okay, if there's a discount by keeping us together, if we have this, this and this entity, the sum should be greater than the whole. Okay, so they're establishing some of the parts value and eliminating the diversification discount and redeploying assets, etc. Optimise capital or tax structure. Sometimes exits are done to pay down debt. Not a great reason to do it, but sometimes a company will decide, let's focus on our core operations and use the capital to pay down debt. Sometimes tax will be a reason. Often it's done for internal political reasons sometimes, or accountability reasons. So you have an internal division. When you're spinning off an asset, if you have an internal division, that division will now become its own entity with its own CEO. So it'll have its own board, its own CEO. It'll be directly accountable to the stock market, as opposed to being within your structure where they're just reporting to a CEO. So sometimes it's to increase accountability. Sometimes it's because of political reasons. The management team might be wanting to go unless they have their own company. Okay, that happens as well. So give the divisional management team that you're exiting direct access to the stock market. And that also reflects in growth. Okay, now the business can do its own capital raising. It can use its shares now for its own takeovers in its own sector. Okay, so these companies now can directly access the equity capital markets. And obviously that imposes a market discipline on them as well as accountability. Okay? So, what are the types of restructurings we're going to look at here? Let's just go over that last slide first. Before we look at restructurings, what did we cover in that slide? Okay? Of course, increasing diversification. What you're doing by exiting is reducing your diversification. Okay, but the end result or the theory or the thinking is it's not effective diversification because that asset doesn't fit. The benefits of diversification, I guess, outweigh the costs of that diversification. So let's look at the types of restructurings. Of course, divestiture is the most obvious. Okay? Exit, just selling. Equity carve-outs, spin-off. In Australia we call them demergers. The US name is typically spin-off. Here we call them demergers. Split-off, very rare structure. We'll talk about that, but very rare. I haven't seen it here. And tracking stock. Quite rare, but does occur a bit more frequently. Okay, so these are forms of exits. How do you decide on which type you would choose between these? Depends on how much you want to retain. Some of the dimensions here for deciding between these is how much you want to retain, how core is the business to your remaining operations, what are the synergy benefits of keeping them together or splitting them, and how much do you need to control. Okay, again, some empirical analysis. 44% of US acquisitions divest their targets in 5 years. Okay, so half of all acquisitions, close to half of all acquisitions, are eventually sold within 5 years. Okay? Indication of the salesmanship of investment banks, I think. They can get you in and they can get you out. Almost half of, that's not a good sign for corporate. I'd say that's been dropping off lately. I'd like to see the latest. I think that study was to the mid-2000s. I would say that that's dropping off. Okay, because companies these days are getting hit very hard if they make silly or empire-building M&A. Okay, and I think that percentage would be dropping today, would be my sense, but I'll have to look at new evidence there. Almost half of divestitures were failed or unprofitable acquisitions. So half of M&A exits are due to previously poor acquisitions. Okay? So there seems, as you can see here, it's a little bit of a merry-go-round. Diversifying acquisitions are 4 times more likely to be divested. So of that 44%, I'd say a big chunk of those are diversifying transactions where they realise later on they shouldn't have made that acquisition. So probably that is skewed. If you're making focused transaction, that percentage would be somewhere down in the 20s or 30s, I would assume. Sellers' remaining assets become more profitable. Okay. Negative synergies eliminated. Performance gains when the seller sells off. So let's go through each of these. Divestiture. You will have to be able to know how to draw, and this is actually good for you in your career, structure diagrams. Okay? You have to, obviously not as an analyst, but by the time you're a VP, for example, in an investment bank, you have to think on your feet on how a structure might look like diagrammatically, like this. Okay, these are very simple ones. So this is an exit. Here you have the before. You have a parent with 2, say, unrelated businesses, sub A and sub B. Sub B is non-core. Okay, so what do? We sell off sub B to a new owner for some dollars, and we give them title to the shares in sub B. Okay? So often a private transaction could be a public transaction. So in other words, the buyer is another company. Could be a public transaction or a private, but most divestitures are to private buyers. And divestiture or exit is about 1/3 of M&A. So again, if you're going into transactions, and I'm not just talking investment banks, if you work for a corporate development, business development division of a company, about 1/3 of your work will be exiting. Okay, and probably 2/3 will be buying. Probably actually, if you're in that kind of sector, it would be something like 20% exits, 30 to 40% buying or bids, and probably 30 to 40% capital raising, either IPOs or debt raising, or structured deals like that. Anyway, it would depend on the sector, but that's roughly exits. In other words, exits are a big part of what you do in any transactional employment. Okay, there's nothing here of note. Of course, payment can be in cash or securities. Okay, captures the seller captures the benefits or the opportunity cost in the exit price. Divestitures increase shareholder value if sale price exceeds the PV of the sale. So in other words, if this person here, this company or entity is the more logical owner than this owner, then there should be an increase in value. In other words, that entity should pay more for that business than it's worth within this conglomerate. And that can be a shares or asset deal. You can sell by shares or assets, referring to our work from 2 weeks ago. Okay, next one, carve out. Basically, to summarise, exit by way of IPO. Okay, and the most common motive that this is done rather than a straight divestiture is to retain some level of control. Okay, so a lot of companies will IPO their business and maintain what we call a cornerstone share, or a big block, like 30 or 40%. Gives them enough control, but they release the capital from the business, they share some risk with a new bunch of shareholders. But this is basically exit by what, exactly the same, but now you have new public shareholders. Okay? Rather than selling to an entity through a strategic sale, or what we call, this is also called, you might have heard, this is also called a trade sale. This method, divestiture, is called a trade sale. Okay, trade sale. This is called exit by IPO or an equity carve-out. So initial public offering of stock in the wholly owned subsidiary, you have to write a prospectus. So here, sub B exists under the parent. Here we would have to write a prospectus for sub B like we're doing an initial public offering. So like any IPO, we'd have to write a full prospectus. We would still get the dollars and release title to a new public shareholders. Now why would you do it this way as opposed to a trade sale? As I said to you, the main reason is to maintain control. The second reason is if you believe it'll maximise exit value. So a lot of investors exiting companies will run what we call a parallel process. They'll run a trade sale and they'll investigate an IPO at the same time, sometimes to create competitive tension for the trade sale as well, the divestiture. So in other words, sometimes you think you're going to do a trade sale and you'll only get 2 bidders. A smart thing to do would be run a parallel IPO and then you have a 3rd bidder, effectively. Because if the 2 bidders play games with you in their bidding strategies, you go to an IPO. So sometimes it's done for maximising value, pure, what's my maximum dollars that I can get on exit? And sometimes it's done because the exiting company, the parent, wants to maintain some degree of control. Okay, so they sell off 60%, say, and keep 40% of the shares. And sometimes it's done for both those reasons. Maximise value and retain control. Means of raising funds, reduces parent control over subsidiary. After the carve-out, so this would be a new listed entity. Okay, many times this has been done. In Australia, example would be South 32 out of BHP. Coles out of Wesfarmers was a recent example last year. So this is done many times. Okay, what does Wesfarmers still own of Coles? Isn't it 20, something of the 20 to 30%? So they still retain some of Coles, even though they've carved it out. Okay, so very popular in the US. They are popular here too, by the way. They happen very often here. There's probably about 10 carve-out transactions a year here, 5 to 10. Maybe closer to 5 actually. So they're not rare. They happen quite often. Now that entity sub B now becomes a new public company with its own board, its own its own capital structure, its own CEO, its own reporting requirements. There's nothing, this company no longer directs this company as to how it reports, or it'll have its own management team that'll make its own decisions and its own board. Now, in the old days, this used to be what we called a stuffy. You stuff all your bad stuff in there and put all your debt in there and keep all the good stuff in the head company. Okay? And so these carve-outs used to be notorious for being over-geared. Okay? You get rid of all your debt, put them in this company, list it off. Again, stock markets and capital markets have caught up with strategies used, and nowadays this company, if anything, is often under-geared when it's spun off. Okay? As example, South32 spun off with no debt. Okay, so because the entity spun off has to have its own prospectus with its own capital structure, its own credit rating, these days it's often very conservatively geared. Parent company typically retains a controlling interest. Now in the US, the median is over 50%. So in other words, they spin out less than 50% and retain 50% in terms of the median. Most carve-outs stay in their initial form for a short term and then followed by a second event. And the second event is either a wind down of the structure, meaning the parent company takes it back at some future point, okay, or it fully exits the carve-out, so it doesn't retain the 50%. So most carve-outs have a second event. So the structure is almost like a temporary structure. It's like a holding pattern. And then eventually, more often than not, the parent company sells its shares off. Okay, sells its share off when it realises it doesn't need control. However, sometimes the opposite occurs. It realises it needs control back, and it'll take it over.
Is that second event usually a claim for the carve-out?
No, often, well, in my experience, no. It's circumstances change. The company realises either it doesn't need to hold that 40% to get the benefits, so it'll sell it off, or it's realised it's given up something that it needs to control again, and it'll make a takeover offer.
The very last one is delisting.
Is delisting?
Yeah.
Yeah, taking that over.
Okay.
You bring it back in. Yeah. Demergers, also quite popular. Now this is exiting by giving the asset to your shareholders. Your shareholders, not new shareholders as per initial public offering. A new IPO is new shareholders come along. Now those new shareholders may be your shareholders, but it's not directly targeted to them, it's targeted to any shareholder. A demerger is a cashless transaction where basically, think of it as this, it's a spin-off of your assets to your own investors, resembling a dividend. Okay? The dividend is the asset. In other words, you give them a share in an entity. So see here, public shareholders, there's no new buyer here. See in the previous diagrams, there's a new entity, new public shareholders, or a new company. Okay? This is an IPO. This is no new entity. All you're doing is you're saying, here's a distribution to my own shareholders of a company shares. We call that an in specie distribution. An in specie distribution, okay? So it's a distribution of shares in a subsidiary to your own shareholders as a non-cash dividend. Now, all that happens is you're transferring shares. There's no second way. You're not getting dollars here. No dollars back. Okay, so you're not raising capital. All you're doing is splitting your shares in two. Okay? So the distribution is pro rata. The distribution is pro rata, so it doesn't. So if you're a 10% shareholder in the parent, once the in specie distribution is made, or the special distribution or dividend is made, you'll own 10% of the same parent company and 10% of the new company. Okay? No cash inflow. Creates a publicly held stock in the sub and reduces or eliminates. Again, the parent can continue to own, say, 40% of the sub. Okay? So that was, so the Fairfax demerged Domain. They gave their own shareholders shares and they retained 40% of that order. So it was done by in specie distribution there. They didn't actually raise any capital.
What's the logic for the company?
The logic is often because they don't really need the capital of a sale, so they don't need the money, the funds coming in. So for example, if you take Fairfax as an example, they had no debt on their balance sheet. Why would they sell and get 500 million on their balance sheet? They just distributed it directly to their shareholders. That's the most common one. When there's no credit rating or imperative for you to raise funds, and in fact you're under-geared, if anything, you just distribute it to your own shareholders. Okay?
You done it with listed companies as well,
Unlisted?
right? Unlisted.
Could be done with listed companies. What do you mean?
Publicly listed.
Yeah, this is a publicly listed. Yeah, it can be done privately as well. Yep. It also can be done for tax purposes too, because there's no, you're distributing it to their shareholders. It's not a capital gains tax event. They don't pay tax on it. So there's a whole bunch of reasons why it might be done. Or you believe, you know, the value arbitrage of the dollars you'd get in from a sale are less than what the two shares would trade at in the stock market. So it might be a value reason that you do it. Okay, not that rare, this structure. It does happen quite often. Like, as I said, Domain was an example of this. Now that, similar to a carve-out, that is a separate company. Own board, own CEO, own reporting dates, own reporting, everything is separate. Okay, it becomes its own new company. And it's tax efficient, as I said. When you distribute the shares as an in specie distribution, you don't pay any capital gains tax on it. Okay, so it's often done. It's often not done for that reason, but has that benefit. So, this is not necessarily why would you choose a demerger over the other alternatives, but why? What are the benefits of the demerger overall? It creates greater transparency. Now you have two sources, as again, Fairfax, the old newspaper company that declining revenue, spun off its Domain business with fast growing revenue because it believed that the value of them separate was greater than the value of them together. And that indeed is what happened. I mean, the market valued Domain a lot more as a standalone entity than it did within the umbrella of Fairfax. Unlocking hidden value, creating greater transparency, management accountability. We've all talked about, I think we've talked about all of these. Creates a market for subsidiary stock. So now the entity you've spun off can now access its own equity, the equity markets for growth. It now has scrip currency to make its own takeovers. Doesn't have to rely on the head company, can go direct to market. As I said to you before, shareholders are often concerned by capital structure split, and these days, if anything, spin-offs and demergers and carve-outs, the entity being spun out often is under-geared, if anything, because shareholders really put pressure on the parent company to make sure the new entity can survive and stay as is. Removes chain of control, etc., etc. We've talked about these. Often undertaken over divestiture or carve-out when the parent is modestly geared and does not require cash from sale proceeds. That's the most common reason why you pick a demerger over a carve-out or a divestiture. All right, these two are rare. These two are both rare. I've never seen a split off. Okay, so this is company. These are just the after pictures, okay? The before pictures are as per the previous slides. So these are both after pictures. So you had parent A and sub A and B, and here you spin off a particular subsidiary to a particular group of shareholders in return for their shares in the parent. Okay? So the only real reason I could think of split-offs occurring would be you had a major shareholder who's agitating about your structure, and sometimes almost as a defence, you say to your major shareholder, all right, look, give us back your 20% shares and we'll give you the business. Okay, so we'll give you one of our subsidiaries, and the consideration is they give you back. They effectively are giving you back their shares, and you're giving them a business for it, okay? So that's called a split off. A group of shareholders, most likely one or more significant shareholders, swap their shares in the parent, so they give back their shares and they get shares in the sub, and then the sub, they become owners of the subsidiary, and here where this parent had, say, 100 shares on issue, they now have, say, 80, okay, because 20 would be cancelled, which would be this public shareholder shares would be cancelled, and in consideration for their shares that you cancel, they now get a business. Okay, that's called a split off. This one has been done a number of times, but very rare, tracking stock. Now this is where, so your motivation here could be defence, or your motivation could just be you believe one group of shareholders is the more logical owner of your assets than you are within a conglomerate, therefore you spin it off to them and you remove that shareholder from your asset base, shareholder register. Over here the motive is often because you believe the markets aren't fairly valuing you, so tracking stock, the markets aren't transparently valuing your value. In other words, they've got this diversification discount. However, you believe it's best to still keep the assets together. Okay? So, what happens here is sub B remains 100% owned by the parent, but all that's happening is its cash flow is effectively monetised. Okay, so you have an economic right to the cash flows of that business. You'll receive dividends. So this could be in the form of a carve-out. You carve it out to a new group of shareholders, but they don't own the asset. You continue to own 100% of the asset. Could be for tax reasons, could be for certain financial or capital structure reasons. It could be certain agreements that can only occur when they're under the one umbrella. However, the dividends, the economic interest goes to a new tracking stock. So when you're buying it, so obviously, if I'm a buyer of a tracking stock, okay, I'm going to want a higher return than a normal share because I get all the economic benefit of that. I get the same dividend, but I have no voting rights. I have no control over its decision making. I don't have legal ownership. All I have is an assigned cash flow to me, meaning legally the company is obliged to make the dividends to me, but I don't have any ownership for that. Okay, so probably there'd be a big discount between a tracking stock and a normal stock. Okay, so it's a synthetic transaction. Has occurred here in New Zealand and Australia. Fletcher Challenge did it They broke off their building, so they had a diversified conglomerate of building activities, forestry, paper production. So they split off their forestry and paper production from their construction business. Okay, but they believed that they should retain ownership of the forestry business. So instead of selling it off, they created a tracking stock. So I could buy Fletcher Forestry, meaning I had no ownership of their forestry assets, but all the dividend flow comes to me. Okay, so it's an assigned cash flow. May be motivated by the parent wanting to retain ownership due to unique synergies. So the parent obviously believes sometimes there could be historical taxation reasons. There could be Fletcher Challenge tracking stock was highly driven by tax. Okay, sometimes you want to keep the companies together, the subs together, for tax reasons. So legally, Fletcher Challenge still owns Fletcher Construction and Fletcher Forestry, but Fletcher Forestry was assigned, its dividends were assigned to a new group of shareholders. Increases transparency while maintaining synergy. It's a synthetic transaction. The parents still own the subs, but the economic interest goes to a new group of shareholders in return for cash. So in this one, this one would be a cashless transaction because all you're doing is transferring your shares, so split off. You're giving them shares in return for their shares, no cash. This one is cash. You get dollars for these tracking shares. Okay? So you have to be able to describe all of those restructurings. Any questions?
How would you split up the dividends that comes from sub from dividends coming from other subs? So they're still under...
Yeah, it's still a sub, and there's transfer agreements on how things like tax would be shared or capital structure issues would be shared. They've got transfer agreements as to how they price things between each other. And it's complicated. It requires, a tracking stock would need 5 or 6 different contracts to execute. You'd have to have a tax transfer agreement. You'd have to have a capital structure or interest paying agreement. All of those things. But generally, you're getting the money from the sub. So you're getting it from a legal entity, but the legal entity is owned by somebody else.
Accounting will be still consolidated.
It's consolidated, yeah. Yeah, but then it's consolidated at the head level, but then also there'd be the tracking stock would see their accounts as well. So it would be consolidated at the parent level, but also every individual stock would have their own reporting. Okay, so let's ask you a question on it all. I think we covered it, but let's see. Company needs to restructure to pay down debt. What forms of restructuring is it least likely to favour? Okay. Least likely to favour. Good. A and D. Cashless transactions. No cash is transferred for either a split off, or a spin off. Okay. No cash. So often those are chosen because the company is under-geared and doesn't particularly require funds. All right, so those are equity restructurings. Now let's look at liability side restructurings. Of course, buybacks, not really a core focus of this course. Buybacks, how are buybacks funded more often than not? Sometimes they're funded by selling off a core asset and you use the funds to buy back your shares. More often than not, they're funded by increasing your debt, okay, or reducing your cash to finance equity purchases. Debt to equity and equity to debt swaps. Now, these are mostly done when a company, debt to equity, equity to debt swaps, very rare. I can't remember any examples. But debt to equity swaps are done quite often where a company is overgeared and it wants to convert its debt into equity. And the debt holders realise that if they fully enforce their rights, the company will go into liquidation and administration, and they'll probably lose out on getting their 100 cents in the dollar back as a debt provider. So sometimes the debt provider will say, yep, all right, we'll convert our debt into equity, and often that's bad news for the equity holders because they get diluted out of sight. So probably the debt holders will get 80% of the company, and the equity holders who own 100% are reduced down to 20%. Now they get to vote on that, but they generally will vote in favour because their view is 20% is better than zero. And if this company which is technically in default and in administration, if I don't accept that my equity gets diluted down to 20%, I'm going to get nothing. Okay, so it happens quite often actually. Many examples in Australia, debt to equity swaps. But they're not really core for this course because they're mainly distress situations, companies in financial distress. Now what is core, as we'll talk about, we're going to spend time on this with Hilton, so maybe we can park a little bit of this, but this is a very common defence. Leverage recap, okay? Not really used in Australia because again it would typically constitute a frustrating action here, and we don't allow those, but in the US, leverage recaps are often used as defence, which is you make a large-scale dividend, sometimes a buyback, funded by a significant debt issue. So a company comes along, pays $50 a share, and for an under-geared target, and the under-geared target says, all right, well, we'll go raise a couple of $1 billion in debt, and we'll pay you $40 a share, and you can continue to own us, and we'll be worth more than $10. In other words, $40 or whatever we pay you out plus what's left is going to be worth a lot more than the offer of $50. We'll specifically talk about that with Hilton, but basically Hilton made an offer of $55 and ITT came back and said, we'll pay you $70 and you can continue up to own us. So why would you take the takeover offer? So we'll talk about that later on. Typically it's lazy, mature, stable companies that sort of haven't maximised their balance sheet and have a lot of financial slack and they're under-geared, but they have safe assets that they can gear up dramatically, or perhaps excess assets that can be sold off, okay? So let's look specifically at that as a defence when we're talking about Hilton. We can talk specifically about a leverage recap, okay? Because that is important for this course, because actually this form of defence is quite often used in the States. All right, any questions on any of that, or let's go to LBOs. This won't take too long because we covered a big chunk of it last week. What is an LBO? Leverage buyout. Okay, requires two components. It requires highly geared financial structure, and it requires a listed company to go private, take it off the markets or delisted. And really requires a third component, which is a financial buyer. Okay? If a private company took a private unlisted company, took over a listed company and took it private, but it was a strategic buyer, often those aren't classed as LBOs. Okay? And I think Thomson and Reuters wouldn't class them as an LBO deal. So it requires financial sponsor like a private equity fund, high gearing, take private. Okay? MBOs, less common these days, but sometimes it was the management team that actually made the offer. The management team, for example, already owned, say, 20% of the stock. They got some big backer to back them for the remaining 80%. A lot of debt in there, and the management team actually ends up owning the stock. That's called a management buyout. Very less common these days, much less common. And the target becomes a private firm. Now, what is a LBO or private equity fund? Okay? Again, raising funds and that kind of aspect isn't core for this course, but let's just have a quick look. What are the typical stages of raising a private equity fund? Okay, or effectively executing a private equity fund strategy. So private equity funds are basically take private funds. They are unlisted, although these days they can be listed. Some private equity companies list their units on the stock market, and you can buy shares in a private equity fund. Okay, but most of them are unlisted. Their investors are institutions or high net worth individuals. And in the old days, they used to focus purely on take private deals. These days, most of their transaction volume is PE to PE. Okay? They're not even doing many takeovers. Or they're doing private deals. But the model was they were a take private fund, meaning they made public takeovers and took them private. So what did they do? First stage is fundraising. Okay? A bunch of financially savvy people would form a fund, a management company. Now, it's not their money necessarily, and often they don't have a lot invested, but you're paying them for their expertise. They form a management company. They raise funds from pension funds, sovereign funds, high net worth individuals. Okay? And they get commitments and drawdowns as opportunities arise. So often they don't raise money up front. They get a commitment from you. So if you're a pension fund, you'll commit $100 million. Okay? And then that private equity fund can draw down on that money progressively as they make acquisitions. They wouldn't raise $100 million from you up front because they just have it sitting in a bank account till they invested it. So often it's done by commitment letter. However, you're bound, if you're a pension fund making commitment, you're bound, that $100 million is effectively the private equity funds. However, they draw it down over time. Okay? So that's the fundraising stage. Often takes a couple of years. Sometimes longer, sometimes shorter, depending on your reputation. Now, that's your first fund. Your follow-up fund probably takes 6 months as a private equity fund because each fund is often closed-end. So you raise $1 billion, you go out and invest it. Then maybe even that fund isn't fully invested, but you'll raise a new fund. Okay, and then the follow-up fund probably takes you 6 months. But the first fund probably took you a year or two. Now, all of this stuff can occur concurrently. They don't have to be sequentially. They can be concurrently. So while you're raising funds, you've obviously got a strategy that you're selling to the pension funds. You might have identified some targets. You might have told them the type of acquisitions you're looking at and what the types of returns or the type of strategy you're targeting. Okay, so you start identifying targets. It's a closed-end fund with a typical life of 10 years. Most PE is around 10 years. Typically, it takes around 5 years to invest and then 5 to 7 years to exit. Okay? So they're looking at 5 to 7 year exit periods, screening assets and doing due diligence. Now, those two things can happen at the same time. Once you've closed the funds and raised the money, you can start doing actual takeovers. So now you can start to make takeover offers. 25 to 50% comes from the PE funds, with the rest coming from either senior or sub-debt. That's a typical structure. Again, 20, 30 years ago, it probably would be 20 to 30% from the PE fund and 70% from debt markets. 70 to 80%. Today, we're a bit more conservatively geared in private equity. And you take it private with some appropriate management incentives, form a newly privately held company. Then there's the operation phase. This is where you're maximising the value of the asset, cutting its costs, delaying CapEx, for example, addressing agency issues, increasing its revenues, selling non-core assets. This is the value creation phase, enhancing the EBITDA. And lastly, exit. Once the business is performing optimally, take improved company public or sell to a third party. Okay, much of the value creation on exit is from debt reduction. We talked about that last week. And ideally, you get some multiple expansion as well on exit. Now that's why probably private equity is one of the more exciting areas to be involved in. Because if you're a private equity executive, you're involved in fundraising, you're involved in transactions, execution and origination of transactions, you're involved in operations, which an investment banker is not. In other words, you'd be sitting on boards. You're an MD, a managing director for a private equity, you'd probably be on 3 or 4 boards. You get to know how companies actually run and how boards actually run. And then you get to exit. So you follow the full transaction all the way. Okay, so I was an investment banker again for close to 20 years, 15 years or so. And then in the last few years I worked overseas in a sovereign wealth fund in a private equity style. And certainly the addition of this phase, I felt, made my job a lot more interesting, because I wasn't just doing transactions now, I was following the transaction from start to finish. Okay, I was on a couple of boards and I saw how boards worked as a board member, and I also did some exits. Okay, where we were exiting assets that we'd made a few years before, investments that we'd made a few years before. So this is a very exciting area of financial. The problem is it's quite difficult to get into. They don't tend to hire graduates, although some do, but most of the time they don't. They hire either investment bankers or they hire accounting from accounting firms, transactional people from accounting firms. But generally, it's hard to get into. Okay, it's certainly hard to get into as a graduate. The other thing is they don't tend to hire senior people either. So your top time to move to private equity, so I realised a little bit late, was at the associate or VP level. In other words, 5 years into investment banking, you're still a bit cheap, still not that expensive. They'll hire you. Once you get to director level, okay, they like to keep the money within the partner, so they don't like you very much because you're a bit too expensive. So anyway, very exciting area because you follow the full evolution of a transaction. We talked about this last week. What's a typical profile? High leverage. LBO deals have high leverage, much more higher leverage than the stock market. So average gearing on the stock market would probably be 20 to 30%. Flip it for private equity. 60 to 70% would be the average gearing. Not only that, the gearing is more complex. Non-recourse. Non-recourse meaning, so if I'm a private equity fund with 5 different assets and one asset goes bad, the banks there who are lending into that asset can't pursue the private equity fund for their money. They're limited to just that asset. Okay? Meaning, if I have 5 assets, one goes bad, I can focus on the other 4, and the one that goes bad effectively becomes the bank's problem. Okay? So, often private equity funds will not, and by the way, some of them actually want to raise recourse debt because they believe that if they raise 5 bunches of debt at each of the company levels with recourse to the head entity, that they get much better financing packages. So some of them actually specifically want to eventually get to recourse debt because they believe they can get much cheaper financing. But most private equity would just, everything is a silo. All their assets would be a silo. Standalone. Okay? If one goes bad, it's a bank's problem. Of course, you'd write off your equity. You've lost your equity, but you can't lose more than your equity. Also, very structured debt. As I said to you before, private equity deals, your debt financing page would be multi-layered. You'd have different tranches of senior debt. You'd have some sub-debt in there, some coming from the banks, some would come from the bond markets. PIK debt, or payment in kind debt, which effectively means debt that capitalises, the interest capitalises, okay, and you don't have to repay it. Preference share, vendor loans is another structure. So I sell an asset for 100 million, and I give you a $20 million loan with it. So you only have to raise 80 million. So sometimes the exitor, the party exiting, provides a loan to the asset. Okay, so private equity deals often have 5 or 6 layers of different debt. They're all go private deals. Okay, for public companies, LBO results in the target going private. Short-term holds. So let's go through them. High gearing, go private, short-term holds, 3 to 7 years, with a view to exit by IPO or trade sale or to another financial sponsor. High returns, because your returns are compressed on a short period of time. You're looking at returns up around 20. And that's what you're selling yourself on, 20% return on equity. And counter-cyclical, as I told you before, generally private equity in the business cycle will not buy here. They'll try and buy here and then refloat or bring the company back to market up there. Okay, so it's typically a counter-cyclical. And that's why you're not finding private equity deals lately have dropped off, because the strong bull market we've had, they're just sitting back. And most deals now are private equity to private equity because they believe the stock market is overvalued. Okay? Often a good indicator that we could be sailing into trouble is when private equity stop doing deals because they're worried about overvalued, that we're at the top of the cycle. Okay? BlackRock and all these other private equity funds have come out and said, well, we're not doing deals at this point in the cycle. Okay? I talked about this last week. Okay? EBITDA improvement, high gearing, multiple expansion. And you might throw in there tax advantage. Tax advantages too is another source of value. Okay? Tax advantage would be another source of value too. So what are their ideal targets? Okay, it has to be a leverageable balance sheet. What does that mean? You can't just buy a highly volatile. You won't see many private equity deals in commodities. They do occur, but they're very rare. Okay, because commodities are very volatile. Returns on commodities are volatile. You tend to find them in healthcare. You tend to find them in stable retail. You tend to find them in transport or infrastructure. Stable cash flows, because then they can get the gearing up very high. Okay, stable cash flows. Leverageable balance sheet, not much. Also, probably the balance sheet would have a lot more tangible than intangible assets. Private equity, because banks don't like to lend against intangible assets. They like to lend against tangible assets that at least if everything goes wrong, maybe they can sell some assets off. Okay, so that's what we mean by not only stable balance sheet, but more tangible than intangible assets. Stable cash flows, as I said, low capex. Now, you can't get a lean, mean company and then take it private and expect to increase its operations. So what you're looking for is actually inefficient companies. Inefficient companies. You're actually looking for companies with some fat and some upside. So scope for cost cutting, companies with too many non-core assets that you can sell off and pay down the debt. Okay, so you're actually looking for underperformance, obviously. Motivated management, management that you can either replace or incentivise. And as I said, you're looking for undervalued stocks, not at the top of the cycle. What is the actual fund structure? Most PE funds are partnerships. Okay, they're not companies, they're not trusts, they're partnerships. And the structure is that the management co, so Goldman Sachs Private Equity, Goldman Sachs as manager of that entity is called the general partner, the GP. Okay, so the financial company that's set up the private equity fund, raised the money, supply the executives, could be unaffiliated with an investment bank, by the way, as most private equity is. That is called the GP. So the management team form their own company, I guess, and the company is called the general partners. Now the general partner, and then the individual investors, 30, 40 institutions, they're all called LPs, limited partners. Okay, so it's formed as a partnership with the GP being directing the fund's investments and the LPs being investors effectively. They have a contractual agreement with management fees. Again, 10, 20 years ago, fees were pretty standardised as 2 and 20, meaning 2% of funds under management plus 20% of any outperformance over a benchmark, a hurdle rate. Okay, that's called the 2 and 20 structure. Probably in private equity, this is stuck a bit stronger. Private equity, 2 and 20 has struck stronger than it has in, say, hedge funds and other areas because their hurdle rates are often very high, and therefore the 20% is a reasonable share if they outperform their hurdle rate. Whereas often for the old 2 and 20 structure with hedge funds, for example, all they had to do was beat the index to get 20% of the return. Here they have to earn something like, sometimes it cuts in at the 20%, sometimes it cuts in at a little less than 20%, but in any case, you only start sharing once you make double-digit returns. So private equities tended to hold on to the 2 and 20 a bit better than other sectors.
What about management management fees.
Yeah, that's what that is. So 2 is the management fee, paid no matter what.
Okay.
And then 20 is also a management fee based on performance. That's called 2 and 20. 2 is they get it no matter
Yeah,
what.
yes. It's
And
a
20
fixed
is performance based. The profit component, often how they are paid is they get increasing equity in their fund. So sometimes very little cash is paid in management fees and they just get increasing equity. It's called the carried interest. These days it's called the carried interest. It used to be called sweat equity, meaning they get their return but they have to sweat on it because they're in the same position as the investors.
And there's another thing, like, the 20% is always
Over the hurdle
the
rate.
exit.
Over the hurdle rate.
In the exit.
In private equity, it generally can only be calculated at exit. Yeah. Private equity only get calculated on exit. Whereas at a hedge fund, if you're just betting,
actually.
it can be year on year. What's their typical exit strategy? Well, the classic private equity fund was IPO. You buy a company, you take it private, keep it off market for 5 to 7 years, bring it back and IPO it, okay? That's the classic one. But these days, more and more, because of perhaps overvalued markets, but also because investors are very weary about private equity IPOs, because they've been burnt quite a lot. You're doing sales to other strategic buyers or you're selling to another private equity fund. So it's a merry-go-round. They're just swapping between your 5 years runs out, I'll buy your asset, my 5 years runs out, I'll sell to you, and they're just swapping assets. Okay, so few problems potentially coming up for the private equity model because they're not exiting by IPO as much as they used to. Because institutions are saying, we're not going to buy into your IPO. In Australia, we've seen that here too because we had Myer. Myer was floated in 2008 or thereabouts, Myer department store, for about $4 something, $4.20. Never hit that price ever again. Okay, immediately GFC hit and was $2 within a month or two after the IPO. Missed its prospectus forecast. Class action was launched, meaning they sued the company. I think they lost because the company argued we had no way of knowing that we weren't going to make our prospectus forecast. So within a few months they were at $2 from a $4.20 IPO. Today they're at 60 cents. 10 years later, 11 years later. So the market, but there's a few examples of that, not just Myer. So the market is very weary about IPOs. And as it turned out, then we had Dick Smith. Dick Smith was another one, taken off market for 2 years. Private equity fund made 200% of their money in 18 months. Came on market and within 2 years was gone.
What private equity was?
What private equity? I think it was,
Camps?
which one? No, I think it was PEP, Pacific Equity. I think. But yeah, I mean, they made 200%. They didn't lose any money. They got out at the IPO. They didn't hold a single share. That's the other thing. Many institutions are insisting that the IPO fund retain an interest too when they IPO.
As for exit, you say that IPO PE funds are exiting when it's high economic cycle and it's high EBITDA multiple. But how can you sell the company to other PE that is doing the same thing and they understand which cycle it is now and they want?
Yeah, well, that's the aim. That's the aim. That's why the model is becoming more problematic.
Yeah.
Because they're moving these assets around and the other PEs aren't wanting to buy them. And the IPO market isn't available to them.
So the all options strategic buyer will as more long-term goals.
Yeah. I mean, and that's why we're seeing less PE transactions because they're seeing these problems on exit. Exit is becoming more difficult because IPOs aren't available to them, and they get no multiple expansion when they sell to another PE company, another PE firm. So 4 methods of exit: sale, trade sale, or sale to a strategic buyer, sponsor to sponsor, IPO, or this partial exit where they effectively pay themselves out a big dividend. Okay, so remember in my example last week, you pay down your debt to basically nothing, and then if you can't exit at that time because you're not seeing value on exit, you go back to the bank and say, hey, you're willing to gear this 70% 5 years ago, well now let's gear it 50%, give us back some money. Okay, so you're still monetising the asset by dividend recap. This is a very common way of raising money out of private equity. Private equity are making a lot more of their money by not exiting, but just going back to the banks and saying, hey, we've done 7 years of paying our debt down to basically zero, give us another 50% today, okay, so we can get some money. But we're going to take that money out of the business. So it's like a partial exit. It's called a dividend recap. Okay, so there's 4 equity methods. All right, So I think we talked about this last Thursday. As I said to you, most of the models are 5-year horizons. Private equity tends to model over 5 years. Cash flows are generally used for debt reduction, so the private equity firm, if you buy units in a private equity firm at the start, probably don't expect any distribution early. Your money will be locked up for 2 or 3 years before you get anything as a unit holder. Probably longer. Probably 5 years, maybe more. Okay? So it's unlikely you'll get any distribution because every dollar is going to pay down debt. Tax impact of high leverage and the way these deals are often structured means little or no tax is paid for 3 to 5 years. So you could add that as a 4th source of value for private equity. As opposed to a listed company which pays tax every year, private equity, because of the combination of their gearing, the way they structure the acquisition, certain other things that they do, to all legal, don't pay tax generally. As you say, any private equity person will say, if you're paying tax before year 5, there's something wrong with you. Okay, so 5 years, no tax. And that's mainly because of the interest tax shield, but also the way they structure these things with goodwill, step-ups in the tax base. They get a lot of benefit. Leverage is continually falling as debt is repaid. They do an equity IRR analysis. So equity IRR is the basis for, you don't do WACC in private equity, you tend to do an equity IRR. Okay? Everything is measured against your equity return. And basically, you're looking at how you can drive the valuation levers. The gearing, you want to maximise. You want to cut back the costs in the company and maximise the revenue to increase the EBITDA. And you want to ensure you get some sort of exit multiple expansion. Okay? I won't talk about these steps. But basically, the final line is you're always iterating. I know you're finishing up your iLabs and you're doing some iteration where you're trying to meet some parameters and pay an appropriate price or value the asset appropriately to meet some parameters. That's the kind of thing you're always doing in private equity. Okay, you want to maximise the gearing, you want to make sure you're hitting your credit ratios, you want to make sure that your exit multiple assumptions are realistic. Okay, you want to maximise the capital structure, as I said. You want to maximise the acquisition price so you can get control of the asset, and you're iterating all these things. And if you see any private equity model, they have big Visual Basic algorithms that basically are trying to maximise every aspect of this deal by trial and error. Like you're doing, you're probably doing it manually in your iLab. Private equity models does the exact same thing, but obviously it's all automated. Okay? Solver and Visual Basic and all the things that Excel uses to maximise these things. But it's the same thing you're doing, it's iteration. Okay, so I think we talked about this, no need to go over it again. But basically, with just one of the triggers being high gearing, this fund was able to earn 20%. If I then added some multiple expansion, okay, I get to 33%. If I added some multiple expansion plus some EBITDA improvement, so all three levers, so this is gearing, multiple expansion and EBITDA improvement, I might get to 37%. But I just showed you a very simple model that's showed even with no multiple expansion and no improvement in the EBITDA, the fund makes 20% IRR. Okay? Let's do the last two questions, and then cross-border will take 5 minutes. Cross-border is not core, so it could be a multi-choice question. I won't ask you any short answer on cross-border. What are the characteristics that an LBO fund looks for? So I hope everyone who's only done one has handed in two today. Obviously all of the above. And let's do one more. Which of the following statements is false with regard to LBO valuation? Base this on last Thursday as well, not just today. So which is not a feature of LBO valuation. Okay? The valuation horizon does not depend on the life of the asset. No matter what the life of the asset, private equity funds will model it over 5 to 7 years typically. Okay? And they won't go longer for longer life assets, or they won't go shorter for shorter life assets. It's a very standard way that private equity models tend to value. Okay? All the rest are true statements. So you do need to know that. Okay. Let's quickly look at cross-border, because this will only be multi-choice, okay? In cross-border M&A, the home country, okay, the acquirer's base country is called the home country. The foreign company, the target's base is called the foreign country. And we often call it outbound M&A for the acquirer and inbound M&A for the target. Cross-border M&A is about a third of world M&A. So it's not that it's unimportant for this, it's not, we don't just briefly go through it because it's unimportant, we briefly go through it because the principles are exactly the same. However, you have exchange rate risk, you have specific issues on how you come up with a risk-free rate, there's specific issues on how you derive a fair whack, which we don't cover here, okay? But basically the principles are the same. Of course, you have to know the regulation, but we don't cover that. We only look at this at a very high level. So it's 1/3 of the global M&A, and its deal size is typically much higher than domestic deals. Okay, but they're roughly between 30 and 40% is the cross-border component of global M&A. Modes of entry, we've talked about the possibility of JV versus M&A. This is along similar lines. So what are some of the alternatives to M&A? A lot of foreign expansion is just done by establishing a representative office or having a strategic alliance with a local partner. Often that doesn't require capital. Now, foreign direct investment then has different forms of injecting your capital into a foreign country, either through joint ownership or whole ownership. So wholly owned foreign direct investment could involve M&A, fully taking over a company, or starting from scratch, or building your own factory, or building your own distribution network in a foreign country. Okay, that's called greenfield. And then joint ownership could be in the form of a JV, or just simply taking a controlling stake in an existing entity. Okay? So these are obviously up here, you're testing the water in a foreign company, foreign country, either by representative office or strategic alliance. So often M&A isn't the first step. Very often, cross-border M&A, the inbound M&A or the acquirer already has some sort of affiliation or presence in the country. Okay? Cross-border M&A is more related, and the offers are typically cash. Obviously, you're not going to get scrip offers from foreign stock exchanges. So, cross-border M&A, the big feature of it, they're cash deals. Okay? And they're more related. They tend to be horizontal. Okay? And they're generally not conglomerate deals. Sometimes they are vertical, but more commonly horizontal deals. Now, of course, M&A, as we saw in week 1 and 2, isn't the only answer. Okay? So what are the alternatives to M&A? An organic entry, selling direct to the domestic market, so you're just an exporter. Sometimes the problem with that leads you to M&A is your production costs in your home country are too high for the country you're exporting into, or the transaction cost of getting your product there is too high, and also by not having a presence on the ground, you may have a lack of local knowledge, local market dynamics. So the next strategy may be either a joint venture strategy with or a strategic alliance with a local, leveraging local relationships. However, the problem with that is you're limiting your synergies, your control benefits, and there may be some potential future conflict. Or you could build in the company. For example, establishing a local factory that's called a greenfield strategy. That is very difficult to do unless you have a lot of presence and you've been in the market for a while. To start building distribution networks or factories. See, this is an answer to the problem of your home country's production cost may be too high, or your cost of getting this product to the new market may be too high. Therefore, you might want to build. However, that's fraught with a lot of risk because a build strategy requires you to know the market in depth. You do access local production costs, but you're taking on a lot more risk. Okay? Just know this at a high level. So the rationale for cross-border M&A may be cost reduction, having a competitive production cost, increasing economies of scale or cheaper labour, extending the reach of your market into a new market. You're very popular in your market, however you're saturated. Your market share is as far as it'll go. Therefore, you extend your reach to other geographies. Okay, leveraging your brand name, patents, technologies. Okay. Diversification is another reason. Again, if all of your returns are coming from your home market and your home market might be heading towards recession, as an example, maybe it's time to think about diversification into other geographies. A big motive of cross-border M&A is countries or companies with more sophisticated corporate governance buying into countries with agency costs because they believe the assets are cheap and they believe if they can import their corporate governance structure that minimises agency costs, ideally, they can improve the value of assets. So this is a very big motivation for cross-border M&A, importing your corporate governance from home to a new market where maybe the corporate governance isn't as streamlined and has agency costs. Tax is another, and then things like valuation, currency markets, capital markets, other reasons there. Here's an actual survey. A lot of CFOs said portfolio diversification is a reason. Regulation, favourable regulations, synergies, cost reduction. Okay, lots of reasons there. What's the empirical evidence? Basically, there seems to be less negative. Remember, the empirical evidence suggests that bidders make negative returns. Insignificant, but negative. Cross-border, they don't tend to make negative returns. In other words, it's positive, but still insignificant. So cross-border tend to be more positive returns than domestic transactions, probably because they're more related transactions. They tend to be less conglomerate transactions. So by eliminating that from your sample size, you're more likely to have positive transactions. Corporate governance advantage, as I said, is a very strong link for cross-border deals. A lot of the empirical evidence suggests that this is a big motivator. Cross-border targets are typically cut from countries with poorer governance than the acquirers. There tends to be a home bias, meaning most cross-border tends to be from a country that's close. Okay, either has some historical affiliation or geographically is close. Foreign cross-border takeover premiums tend to be higher than local takeover premiums. Okay. Could be just because they are paying more, typically also because they tend to be larger bidders, have more capacity to pay more. Okay.
Currency factor, you have a strong currency.
Currency. Could be, but all that can be hedged out.
You go for foreign governance, so they're usually...
Yeah, it could be dramatically undervalued, yeah. So you have a capacity to pay more. JV versus cross-border, why would you pick JVs? Obviously they're easier to execute. Management incentives in terms of if you own a company, you have to move that country's management team to whatever your incentive structure is, versus if you had a JV, you could maintain the local management structure. Okay? Complex ownership structure in many markets therefore make it difficult to take over companies, and your only option is a JV. Risk sharing obviously pushes you more towards share ownership than 100% ownership, and this is the biggest factor. Most deals, first deals in a new country, are done by JV or strategic alliance. Why? Because they want to maintain some local content. Because it's been found that if foreign companies take over 100% of a local company, there tends to be customer repercussions. Some customers don't want to deal with them. They were comfortable with the local structure, and they, particularly in retail markets, retail investors like to buy the local manufacturer. Okay? So there tends to be, particularly as a first transaction, foreign companies often do JVs with local partners. Take advantage of the local partners' unique local connections, relationships with suppliers and customers. So if a foreign company took over a local company and sacked all the management, they'd lose a lot of local knowledge. Okay, so generally most cross-borders are a follow-up transaction after something else has happened before. There's a few risks, just to, obviously, you compound your risks on cross-border because of different legal frameworks and currency issues, etc., etc. Okay, and there's just a summary. No need to obviously, what does that say? The more control you have, the more it costs you, but the more risk. The more control you seek, the more it costs you, but the more risk you take on. Okay? All right. So let's take 10 minutes, and then we'll do the 2 case studies. Anyone who hasn't handed in their case study, just hand them in here. And make sure you hand it in 3 case studies. Yeah. Okay, so Arden here and Hilton there, Rachel, Arden here.
我也是啊，你在最后的那个结果是怎么说？
Yeah, that's Hilton.
我写的是他那个周瑜题是
Everyone make sure you've handed in 3.
那个 chair 没有被解雇，但是他是新增加就是20块那个支持那个金额，我也没有说他说。
I don't understand you. Reverse strategy. What is the reverse?
Meaning, after they've got all these the diversified assets together, they reverse the strategy. So, firstly, they bring these unrelated businesses together, and then eventually they sell them off. So, most conglomerates are unwinding their strategy today.
Lecture, some questions about
Yeah.
Actually, I have some problem.
Who are you with? What's the name of? Do you know the name of that guy? Yeah, the guy comes a bit late. Pedro. His last name is.
I don't remember his last name. His name is Pedro. I think he's the
Lopez.
Yeah, probably Lopez. Yeah.
He's the one who's been handing these case studies. I'm amazed. Because he's the. Anyway, keep going, yeah.
Okay, the thing is, as for the group project, several questions. First, we are doing Boral and Adelaide, and Adelaide and Boral claims it needs annually reported the optimal yield is 60% market, 60% to EV. Do you think it's okay to
Yeah,
For me, it's over here something 60%. I look at the
60%. What's their ratio?
that to cap should be 60%. 60% that
Really?
is too much. Well,
For building products, it
so,
seems
so
too much.
they actually say that it is the threshold 60%.
Yeah.
That's why I say let's assume it's 50% because 60
Yeah,
seems a little bit too much. And as for credit,
it sounds high, but if that's what they're saying, I wouldn't deduct any marks because it's justifiable.
but still
It is a stable company, Boral, but
not that stable.
you wouldn't have thought so. Building products are not that stable, but
Yeah, they're not that stable.
No.
There's a thing. And another thing as for
what's it currently geared at?
I thought they are really low, something like 5%. And the another thing is, as for the credit rating metrics, yesterday I spent 3-4 hours time and I registered on S&P website, on Moody's website. They don't give the metrics, the coverage ratios by the industries. So let's say for construction it should be 12 multiple.
Sometimes you randomly find it, like utilities I've found it. They wouldn't give it by industry publicly, but sometimes they randomly publish something.
So the thing I can really use is what the Madaran says, but it is not unique to any industry, so it
Yeah.
just gives that general.
That's okay.
And another thing, maybe
And just comment that you've realised that issue, and you've made, obviously, on my face, building products will be quite conservative.
and two more things. I'm asking a lot of things.
Yeah.
So one more thing would be, would you like the idea that I just take the multiples and then compare them to the peers and say, let's say James Hardy is 12 times EBITDA, that's why I think that their credit rating will be BBB like James Hardy. Would that be a reasonable comparison? Can I
Yeah.
make that assumption?
Credit metrics.
Yeah.
Yes.
Let's say
Yeah,
if
that's
James
the
Hardy
best way.
if James Hardy is 12 and you are getting
Absolutely.
12,
Yeah,
so
yeah, absolutely. That's the best way. That would be the best way. Or I mean, that would be a fantastic way. Even if you took a standard one and made some random not random, but thought through sort of adjustments for building products. But the best way is what you just said.
the last thing, as for transaction multiple. I think Bloomberg a lot and found some good deals of transactions that are exactly because they are buying Adelaide, they completely the same because this cement industry. But the thing is, they are not developed countries. I found a couple of them in Indonesia, one in China, and one is
Adelaide as the acquirer.
no. Just transaction multiples that they compare about companies. For example,
If you can't find in Australia, that's the best you've got.
yeah, China building construction board, China
Yeah.
material.
Yeah.
This transaction is 2 years ago transaction and the
Yeah.
value is the
Put
same.
some of the dated ones and say we didn't take these into account in Australia, because definitely you would have found 5-10 years ago there's quite a number.
2010, 2011, but
Yeah, lately there hasn't been many building products deals that I can think of. Haven't James Hardy done a few things?
it has done, but it's not.
In the US?
Yeah, it's not cement. The thing is, I wanted specifically.
The cement.
Yeah,
Yeah.
all the transactions are 2006 and onwards.
But Boral aren't just cement, right?
Well, isn't just cement. It will be some diversifying.
Oh, but Adelaide Brighton is...
Yeah, Adelaide is
Sorry,
cement
sorry.
only.
Yeah. Good.
Okay.
Excellent. Sounds
Okay,
good
thank
to
you.
me.
Let's see what happens in a week. We don't have presentation yet.
But just put very good write-ups on it. Or-
Let's see. It will be my first M&A presentation.
I want to ask, like, we are doing in front of the broker on slide. I think this is financial service. So I've been trying to using the book multiple and dividend multiple.
Yeah, or PE, yeah.
But
PE would be alright.
yeah, and PE is very multiple. But it seems like book multiple and dividend multiple is not reasonable.
Is not what?
Reasonable. The price is
Highly
low.
volatile. Don't use dividend.
Yeah,
The big banks go on dividend. Go PE multiple and book multiple.
yeah, and instead I using IPTA and EBIT.
Don't.
Don't use it.
No.
So I use PE multiple and the book multiple is fine.
Yeah, they're the best for that sector.
Thank you.
Yep. One. Yep, one's good.
About paying for saving.
Cost savings. You tell me. Go through don't make it ridiculous, but just go through and have a look at the notes to the expenses. So in the P&L, there'll be expenses. Look at the notes and see if there's anything there where you can reduce the costs. Maybe they break down marketing costs. Marketing costs, you could cut 30% out. Employees. Say, we assume 5% of employees could be cut. 30% of marketing costs. Maybe they have things like corporate office or headquarters costs. That could be 30%, and that's enough. Just show some degree that you're looking at the accounts. So, yeah, in the annual report, on the expenses in the P&L, there'll be a note. Read those notes. That sometimes tells you all you need to know. Okay? But don't make it, overall, don't make it more than 10-20%. So if the cost is 100 million, make it 80 million, you know? Don't make don't make it, some presentations they have this 100% synergy, and then the value they can pay is like 10 times, 5 times the current price. You have to make it nice and reasonable, and just get your assumptions. Don't spend much time on it from the annual report. So read the notes from the annual report. That's the best way, and anything else you can get on. So when management talk about their costs or break down their costs in management presentations, have a look at that. Okay?
We do the real estate industry, so can we use dividend yield?
Which industry?
Real estate.
Real estate, yeah.
So can we use dividend yield?
So your synergies won't be very big. Acquisition of real estate assets, is it acquiring a REIT?
It's trust. Yeah,
Your synergies will be minute. Maybe some capital structure synergies, but actual operations of buying buildings, you're not going to get big cost reduction. So I wouldn't assume big synergies for real estate. But yeah, dividend yield, funds to investors divided by share price is a good indicator. NTA, value to NTA, net tangible asset value to share price is another indicator. PE ratio less meaningful, but because it's captured in the distributions line.
What about the fund from operation?
Yes, that's exactly what I said. So when I said distribution, some call it distributions, funds to investors or funds from operations. That's exactly how you compare it. Well, in real estate, you don't have much. If it's just a company buying assets, real estate assets,
Is it okay for
it's okay. Have a think about what's your exact deal. Okay, well they might have some back office management, but it's going to be small. Might be 5%. So because now there's one manager acquiring two sets of assets together, you can get rid of a lot of the legal people and reporting and the board. The board, each of those funds would have a board. You can get rid of all those boards. So it's going to be small. 5% would be reasonable, something like that. But have a science to it. Go through it. It's not going to be 20%. Like there's not real synergy. It's all back office things.
this is a change?
It's not a deal you can dramatically show off with, and like it's not. But if you do a good job, there's no reason you can't get perfect marks with that deal. But you know, if you do a really synergistic deal, you can show off a bit better. It's more impressive. Yours is a bit boring, but it's all right as long as you analyse it well. That's important. Okay.
About the WACC calculation.
Yeah.
Yeah. For the discount tax DCF for the target, yeah, we should use the beta the bidder's capital structure to calculate the WACC. Why we should use the bidder not the target's capital structure?
Well, you could use the target's beta, but you use the bidder's capital structure. So for their capital, because they're the ones financing it, so that's their cost. But you may adjust their cost by the beta of the target.
Yeah, so when we use the discount cash flow to calculate the synergy and mutual benefit, we also use the target, the bidder's capital structure, or
To calculate the synergy. Yeah, all the same. You don't use different WACCs, just use one WACC.
no, I'm proving that I calculate the AGL's WACC and it's about 5%.
Yeah.
But I found that on the annual report it's about 8.5. So which one should I? All the WACC I calculated.
Did they show you how they calculated the 8?
No, they didn't. But just say the WACC is about 8.5%.
For AGL?
Yeah, for AGL. But my calculation is about 4.5.
Did you use the right gearing ratio and everything like that?
Not sure.
So you have to use their gearing ratio. You don't come up with your own gearing ratio, you have to use theirs.
Yeah, the gearing.
AGL report, the cost of capital should be 8.6.
Yeah, I know the gearing about 20.
We'll use their gearing ratio. If you believe the betas are different, that's okay, but you should use their gearing ratio.
Just use the zero report. This is why.
It's okay to use this, but make sure you derive it. You derive it your way.
Yeah, so it's, yes.
Maybe it means that their gearing is a lot lower than what you're assuming.
I found on the annual report and
What's your cost of debt?
it's 6%.
Okay.
If I use the bonds,
I mean, if you can justify yours, it's fine, but probably if it was me, I'd try and see what I needed to do to get to theirs and see where the differences are. They might be using a very low market risk premium or a low beta, obviously.
I think the higher cost of debt side.
That wouldn't make too much of a difference if the capital structure is only 20%. It's really coming from the equity side, the differences. So have a look at what the differences are there. But, you know, if yours is justifiable, it's fine. But I'd try and see why you're getting such dramatic. If they're at 8.5 and you're at 5, I'd try and up my number a bit.
Yeah, so the DCF, when I use the DCF calculate the share price is the offer price that I will give them.
Overpriced?
It will be the offer price. So
Yeah, the DCF. No, well, it depends on your judgment. DCF is one of your measures. You might decide to pay more or less than the DCF.
Yeah, and should I calculate the standing and benefit together?
Yeah, it's okay for this one. Yep. They'll run it together. Okay?
Yeah, I want to ask you, Martin Green might ask you, you choose
The financial.
broker.
Yeah.
Why you speak about book modifiers?
Why do I what?
Yeah, you should just use book
Or PE multiples.
Well, why you speak
Because their assets are liquid and the book value is often a very good indicator of what the fair value is. Financial companies have liquid assets. Like if I'm an old industrial company, my assets might be property in the middle of nowhere that I haven't revalued for 50 years. Financial companies value their financial assets day to day. So it's like a current value. And then book value is very good indicator for financial assets.
brokers, but I don't think it's banks. And
For
also,
brokers?
Yeah, only for brokers. It's kind of financial broker card. But I don't understand why it's doing
For banks? I'm not talking about banks.
I'm talking about brokers.
Well, for brokers, probably, probably PE ratio, yeah, depends. Could be, I'm not sure. Brokers.
We use a book value.
When I was talking about financial assets, I was talking about banks, like,
Not banks. Not banks.
you're not doing banks.
No banks. Yeah. Financial brokers.
Yeah.
They provide
PE multiple would be good.
And also, I saw 59% of what I use revenue. So that gives me
Revenue what?
revenue numbers. Because I see it report. They invest companies. Justify that.
It's surprising to me that brokers use revenue multiples.
Because I saw it
Okay, put the quote from the report. Who does the report?
on their company. Maybe
No, who's the report providing the report?
maybe PwC or something.
Put the report in and then use revenue, if that's what it is. I mean, it's not a sector I'm familiar with, but I'm amazed that they use revenue.
Which is a really hard industry because
Yes, it's not a good
it's
industry.
only big value and there was a dividend all down to we found that how to change the period.
That's what I told you in week one. I said, forget about the strategy, pick a financially nice company. It sounds like you
We
made
probably
your job hard for yourself. But it's too late to change probably. And to do a good job of this, this is a good cohort. I think this is a good group. As in midterm and the case studies are high quality. So these presentations are going to be the best. So don't change expectations. I've got very high expectations. You've all told me about good case studies. Don't change now, but spend 30 hours each on it. And you'll get there, okay?
I think he's now we're going to the future.
When you do the deal, does
If you look at the final
do you factor in the valuation?
It's a present value like deal in place, so it's a discounted cash flow of the deal in place.
I know. So you basically, because basically at the moment I have the debt of the deal
Have the debt from the deal.
in the combined.
Yes.
Okay.
Yeah, cool. Okay? Now what's happening?
at least something.
Yeah. Did you do this?
Okay, it's gonna be.
Okay.
I spent the whole day yesterday.
So you cut
Yeah, I cannot do it. Yeah, I'm sorry for that. No, it's
just make up for it in the
no, that doesn't be on.
You lost him up.
Yeah, but at the same time, I do some effort in my work. Last week,
Your work.
I started to get it.
Okay.
They applying for it. So I have.
But you're in an M&A group, what if your mark's low? You're going to go back to your job saying, oh, I gave up 10 marks.
Full time, studies too.
Okay, anyway,
Yeah, I know.
as long as you accept it, I can't change it.
No,
It's not fair to
I'm
everyone. Because I saw it was you and I thought,
But this one was the best.
you were the only one. Everyone else has done it. And thought you would, I mean, basically it's participation. I thought,
Yeah, but I think he's
Like,
here.
if I put more effort, maybe there have this
yeah,
was the ultimate goal.
yeah.
And in case there was each one of the 2%, and that's fine. I was trying to
Yeah.
Oh, should I put more effort for case study or for trying to get access?
Yeah.
So, but at the
You made a
same time,
conscious decision. It's all right.
yeah, but at the same time, I have a scholarship from private institution that I have to get at least 7.5. So it's like,
All right.
question about the capital
Yeah.
expenditure. So this is it's for example, from 2019, this one is 450 plus 1.2, or it's for the whole period, or just each year is
450.
so.
In real dollars, projected in real dollars, and then index it by inflation.
So for each year is 450 plus the inflation.
Yeah, so what you do is project it in real dollars, and then whatever the total is, project it, index it. You know indexing?
Yeah, I know.
Converting real dollars into nominal.
So the base it means this year is 1.2 times. So
1.02, yeah.
So this one is 1.12 times this.
What are you looking at now? Don't worry about that. Don't do anything with that line. All you're worried about is that line.
Yeah, but I'm not.
Whatever your 2019 figure is, you put whatever figure and whatever figure there to make it the same as your 2019. It doesn't matter what your base is and what your growth is. The way I do it would be to put the 2019 base and then the 2018 dollars and then grow by inflation. So put real dollars there and then grow by inflation. Then in the future years, it'll be whatever growth is spitting out of your model. Based on real dollars. I can't tell you more than that. Project it in real dollars and then convert it to nominal, and then whatever your nominal is growing at, that's your growth line.
So based on the work. So this based on which don't use the base rate.
So the base times the growth should equal whatever your nominal should be in 2019.
Just my priority rate just for just 50% use local road, 40% use overhead. Priority rate just
Is this for financial services or what type of business?
I mean, for insurance brokers. So I see brokers are not.
Okay. Is this specifically for brokers? If that's the method, I'm not familiar. So if that's the method that Philistine works, use it. Yep.
Yeah, so we've got
Fine with
like
me.
56 use
Yeah. If that's the best. See, my table was based on big sectors, but insurance, I'm not sure about. If they use revenue multiples, that's fine.
for brokers, not for insurance.
Yeah, yeah. It's
So
okay.
We can use this in all
Yeah, put that in the appendix.
Okay.
Yeah. Okay? No one stuck around? Let's do Arden quickly. Since there's not many of us left. Okay, what's a proxy fight? Yeah, the word proxy just means somebody votes on your behalf. Fight means there's a disagreement on the what the outcome should be, and proxy fight, therefore, or proxy contest means you're voting for a particular proposal that you're putting up. Doesn't necessarily mean for a takeover. Could be to change the board. Okay, so that's why it's called a proxy fight. What do you think of the advantage of a proxy fight versus a takeover offer? What do you see as the limitations of a successful proxy fight? More what? Smooth. Yeah, you can get to your takeover objectives quicker, can't you? And cost you nothing. So the advantages are you circumvent takeover defences, it doesn't require capital, it's quicker, and achieves control influence without needing to pay necessarily a takeover premium. What are its limitations? Yeah, exactly. And you have to share the benefits with all the other shareholders. The benefits are shared. You don't have control over the process by paying money. You're basically subject to other people's votes. Most shareholders are reluctant to give control without a premium, and no synergies, obviously, as a way of getting control. You're not taking it private because you haven't done a takeover offer, so you're not getting synergies. What's the level of ownership required to initiate a proxy fight? How do you go about initiating it? What's the level? 5%. And you can call an EGM with 5%. With 5%, the target or the company that is subject to the proxy fight has to give you the registry. So you can ring up all the shareholders and say, this is our proposal, what do you think? Okay? So most of these proxy fights, they actually set up a marketing line. They get a PR, public relations company, pay them money. They set up a hotline, and the hotline, firstly, is for investors to ring in and ask anything about their vote, but also they start ringing investors and say, what do you think? What do you think of this proposal? Okay, and they're actually push marketing, they're pushing them. What are the key events that you believe may have led to the Ardent proxy fight?
The share price has dropped dramatically in the past 2 years or something.
Yep.
So it must be.
Yep.
They've expanded much quicker than the competitors and the equity markets have dropped through.
Yep. The management team. Yep. Yes, absolutely. Poor performance, weak strategy. Strategy was constantly changing. Poor governance. They changed their CEO 3 times in 18 months.
And they're overpaying their current one.
Current one, yeah.
They're giving him equity without the performance. It's non-performance linked equity compensation. So
Yeah.
he gets it even if the company underperforms heavily.
Yeah.
Pay like 50% above the average CEO. So
Yeah, they got rid of, or the last CEO. Who was the CEO before this? Girl. The female? Yeah. Yeah. She was the CEO of a magazine.
oh, okay.
And they made her CEO of a leisure company. I mean, I don't know. Anyway, it seemed like a strange appointment. So she stood down but didn't resign. So they hired another CEO. So they had to pay. She became chief operating officer or something. So anyway, they were doubling up on their CEO expenses. It was just very poor appointments. Share price dropped, dividend lost momentum in the US. And then there was the Dreamworld accident, which actually happened on the first day of the CEO's employment. What was her name? Suzanne or something? Suzanne Thomas or... Anyway, she wasn't treated very well because firstly she came in when they had this... So Dreamworld, I don't know if you know about this incident, but you know, a person died on a Dreamworld ride, and immediately all of the Dreamworld leisure parks and all leisure parks were immediately lost 30% of their revenue because nobody went to theme parks for a while. And she started basically the week or almost the day that happened. So anyway, it was a very unfortunate set of circumstances. 5 key reasons are provided to justify the proxy fight by Gary Weiss and associate. Gary Weiss is an activist, one of the only ones. He's the first one. He was an activist before there were activists, so he's been around since the 70s and 80s. And in the States now, activists are very popular. An activist is somebody, often a minority, they buy less than 10%, and then they try and change the strategy. They're not trying to do a takeover. And we're going to probably, in 10 years, I bet you we'll be teaching activist investing in universities, because it's becoming more and more popular. In Australia, you're starting to get activist funds, where a fund raises $500,000 or $1 billion, $500 million or $1 billion, and their mandate is to take minority shares and then change the strategy of the board. Okay, hoping to get the share price up, and then they sell out. That's the activist model. It's a model we haven't really taught because it's quite new. But anyway, Gary Weiss has been doing that since the 70s and 80s. He buys minorities, tries to change the board strategy, gets rid of board members, maybe changes the management, holds for 2 or 3 years. Hopefully his shares have doubled or tripled, and then sells out. That's the activist model. Okay, so he was the first activist before it was trendy around the world. He was doing it 20, 30 years ago. So 5 key reasons provided by Gary Weiss and Associates. Further materials are provided in the body document summarise these arguments. I think we've gone through them, haven't we? Poor financial operating performance, uncertainty of the main event expansion, so the US had lost momentum. Unclear strategy, were they selling the US, were they expanding in the US, were they downsizing Australia? What was the focus, US or Australia? More investment was needed in the Oz business because it had a poor safety record.
Yeah, there was a line about franking credits, about so much of the revenues earned in the US that...
Yeah, they have franking credits. Yeah. And poor corporate governance. What exactly is being proposed by the proponents of the proxy fight? Were they trying to take over the company?
No, they were trying to take it over. They were going to appoint 4 new directors, 2 of them would be him, another guy from a US-based director. So he would,
Yeah. 2 independents, 2 affiliated.
Yeah.
So 4 altogether, 2 independents, 2 affiliated. And they were just doing activists. This isn't a takeover. That's why I put it in. The next one is a takeover, obviously. This one was just to the activist model. You take 10%, 20% of the company, then you try and change the board, change the management, change the strategy, and try and get a higher share price. A number of specific proposals are made by the proponents impacting on the board structure. In the context of best practice corporate governance that you previously learned, make an informed assessment on the proposed board structure.
So if they were successful, the board right now owns less than 0.5% of the shares.
Yeah.
If they were on the board, they own about 10%. I think it's very unusual for the board to own 10% of capital.
Yeah.
So it does allow them shareholders, but it gives them a
Yeah. Yeah. More incentive-based contracts they talk about.
Yeah.
Yeah. So that would be good for corporate governance. It would still be independent, even with the 2 affiliated and the 2. The majority would still be independent. Still small size because there's still 10 directors. That would be classed as small size. Continued term limits, so it would still be limited. And in his view, greater expertise because they're getting restructuring people on, specialist leisure people. So there's some good and some bad. The bad is, as you said, the board is a bit less independent, but it's still majority independent. But the good is they're getting more expertise on more incentive-based contracts. And basically, what ended up happening, do you know?
A day before the EGM was supposed to happen, they signed the troops, they elected 2 instead of 4 directors.
Well, they kept delaying first the EGM, didn't
yeah,
they? They delayed it.
Yeah, and then they elected their own US director. But in the end, yeah, I think it was the day before the EGM, pulled it off, they got 2 seats, still on the board.
And he became chairman.
Yeah, he's
Weiss is chairman.
Yeah.
So basically, rather than getting two independent and two affiliated, they gave them their 2 affiliated, and they made Gary Weiss the chairman, and they called off the whole. Now, obviously, they knew they were going to lose. They wouldn't have given him that if they didn't think they were going to lose the vote, or it was line ball and they didn't want to test it. So they would have been beaten, probably beaten in that instance, if they hadn't have done a compromise. Because often you have these where the activist cancels the vote because they know they're not going to get there. In this case, the company was desperate not to have the vote, meaning the company knew it was in trouble. Okay? All right, let's do Hilton now. This is probably the best case study of all because there's so many parts of this course in this case study. Okay? It incorporates so many parts of this course. So even those in the room and even those listening to the recording, if you hadn't read this case study because you did your other 3, read it because it's good revision for the course. Okay? Very good revision for the course. What is a tender offer? So this is probably one of the most famous hostile bids ever because of the amount of action that occurred. Okay, not only was there a first bid, it became a contested bid. Hilton raised their offer a few times. ITT had the biggest defence plan ever. If this didn't work, then we've got this. If this didn't work, we've got this. If this didn't work, we've got this. So it was a comprehensive deal. Let's start from the beginning. What is a tender offer? Recounting the history between Hilton and ITT, what other options were available to Hilton besides launching a tender offer, and why do you believe it chose this course of action?
So, tender offer is an offer to target shareholders when you overcome the board and just go there and say this is our offer, and taking into account their history, it was impossible to be friendly.
Yeah.
And they were really offending each other in the press, trying to put on the air. So
there'd be a history of M&A between them too.
Yeah.
In fact, ITT tried to buy Hilton at one stage, and then Hilton tried to talk to ITT and couldn't get any traction with the board.
So the board was
3 years ago.
Yeah.
To ITT.
Yeah, yeah.
The board weren't friendly with each other.
And just to be clear, tender offer, the word tender offer, right, is any takeover. So even a friendly is done by tender offer. Now I might have confused you by associating with hostile because that's the terminology. We tend to talk about they did it by tender offer, meaning they bypassed the board. But the true meaning of tender offer is every takeover, whether it's friendly or hostile, has the same mechanism. I make an offer for your shares, you sign a form saying you accept it or reject it, or you don't fill out the form. These days it's done online, obviously, but that every deal is done by tender offer, just to be clear. But hostile, when we talk about tender offer, it means has another connotation, which is you're bypassing the board and going direct. You're letting the shareholders decide with their dollars. Okay. So I'm happy for you to use it in either context, but the true context is tender offer is every takeover for cash. Well, every takeover is by tender offer. Okay, but we tend to, the terminology, as I said, in finance isn't always clear cut, and we tend to talk about tender offers as hostile bids. Okay, but the true meaning of tender offer is every bid. Every bid where you receive a letter saying, I'm offering you $10 for your shares, that's a tender offer, whether it's friendly or not, just to be clear. Okay? Hilton. So they had no choice. I agree with you that they had no choice. Or anyway, from the implication in the case study, they had no real choice. What factors allowed Hilton, a smaller company than ITT, to launch a takeover offer for its largest rival? Describe the offer and the offer structure proposed by Hilton. Well, let's do the first. The first one is our answer almost every week. Outperformance. Outperformance, more trusted management, is the reason why smaller companies can take over larger companies. When the shareholder gives the bidder the benefit of the doubt, it's possible for a smaller company to take over a larger company. Okay, so they significantly outperformed on the S&P.
Yes.
Experiencing the takeover of PMI and Bally.
Or Stefan, who managed to get even more synergies from acquisition of Bally.
Yeah. Unused debt capacities.
Yeah, and they were going to sell off Conference as a market for
Yep. ITT was undergeared, underperformed. Okay, so that's that. But what about the deal? What was the deal?
$55 for 50.1% shares in cash, and then the rest in stock.
They were to offer. Another one was $55 to $70. But they didn't bid, right?
Yeah, they didn't bid that. Well, they did in the end,
Yeah.
but it wasn't their first bid. They ended up bidding $70
Yeah.
because the ARBs came in and immediately said, "You're not going to get this for 55."
Because the moment they were going to bid, they included their capacity, that's why.
Yeah. So what was the offer? $55. What was it?
$55 plus 50.1% of the shares.
Yes, but say it in our terminology from the course. So it was a mixed
It
offer.
was a mixed offer, 50.1% scrip, and $55 cash.
Yeah. So what was it?
Mixed.
Mixed. But what was it? What type of exchange ratio was it? Why did they describe it like that? 50.1% in shares. The dollars are fixed, but the shares are moving to be 50.1%. So it's a floating exchange ratio, right?
Yeah.
This is a floating exchange ratio offer. So in other words, you're going to get $27.50 roughly in shares, no matter what our share price is. We're giving you 27. So the exchange rate fluctuates to give you $27.50 in shares, and then $27.50 in cash, roughly.
Why did they bid 50.1%?
I don't understand that. I can't answer. I've thought
Because
about
I haven't
it.
gotten that.
I don't know what was in just 50-50. I don't know. I've tried to think of why that would be.
Control, but what kind of control?
There'll be some. No, it's not control.
Yeah,
There'll be some regulation or something that they're ticking a box. Majority must be.
maybe at that time.
Yeah, something. There's something unexplained. I don't know the reason. I've never seen
Because
that.
this is very specific.
Yeah, I reckon my theory. I should look it up. I mean, someone should look it up. Full points next week.
I would guess that there is a possibility of the second one that has lower sell it, and if it was 50 and the regulation changed, it could be potentially issued in the future. And changing the regulation, for example.
But this is just for the offer. Their ownership would be 100%. They're buying 100% of the business. All that we're talking about is the mix. Why is the mix 50.1 shares, 49? It's hard to know. I don't know the answer to that. And I've never seen it before, so it's not a popular reason or a well-known reason. So I can't answer that.
50% share, not one share.
Yeah, but they're still owning 100% of the company. The 50.1 isn't relevant. That's just talking about the mix. Why 50.1? Why not just 50-50?
It should be 50% share, not one share.
No, but they'll still own 100% of the shares of ITT. It's not a control issue. It's not a control issue.
Can it be a psychological issue?
Sorry?
Psychological issue. It's more than 50.
I've never, I can't give you the reason because I've never seen it.
Internal policy of Hilton.
Could be something like that. We have to make our deals majority.
Stock part has to be more than
Maybe.
50%.
Could be something obscure like that. I don't know. I can't answer that. It's strange. But the point was to pick up that that is an exchange, a floating exchange ratio. Yeah? Okay, ITT's defence included preemptive and reactive elements. Dividing your answer into preemptive and reactive. Very good question. Describe the key elements of ITT's defence against the Hilton offer. Preemptive. Poison pill. Staggered board. Parachutes. That's about it, isn't it? Yeah, those three. Reactive. So many. Litigations. Divested, the trivestiture. So they're going to restructure their assets. Then on top of that, they're doing a leverage recap.
Yeah. And postponing the shareholder meeting.
Yeah, postponing the meeting. There was non-core, even in between, they just sold off some non-core assets. They reduced head staff. They got synergy. So they had an operational response. They had a asset structuring response. They had a liability response on leverage recap. They had litigation response. They had tactical responses on their delaying the meeting. And the end result was the ultimate defensive mechanism, which is they got a white knight in. The ultimate, as it turns out, I'll talk to you about, well, we'll tell you now. They got Starwood ended up buying ITT for $82 a share. So everything, every possible defence was thrown at Hilton. Okay, and that's what you leave yourself exposed to in a hostile takeover. So very good. Hilton had a specific strategy for circumventing, and this is the first line in the case study, isn't it? For circumventing ITT's preemptive defences. Describe what the strategy is. How did ITT attempt to prevent them from implementing this strategy, and how did Hilton respond to this? So what was the specific strategy?
So they timed the AGM correctly.
Number one, yeah, because they were trying to. Yeah. So obviously, ITT had a staggered board with no teeth because they had a staggered board, so everyone was on there were three types of directors on non-concurrent terms, but they didn't have a limit on the number of directors they could have. So Hilton came along and said, well, we don't have to wait, we'll just give 20. So their staggered board defence was useless. So no one had realised that. This might have been one of the first transactions where somebody tried to get around the staggered board by just increasing the board size. So with 25 directors, it didn't matter. In other words, Hilton wouldn't have to wait a year to the next AGM to get a majority. And then what would happen next? Assuming this worked, what would happen next? Exactly. Yep, exactly. So that was their strategy.
Yeah, but it didn't happen.
It didn't happen because ITT did what?
They postponed the AGM.
Delayed the AGM. Exactly. Very good. And then didn't Hilton respond by threatening litigation? Yeah.
They asked the court for the injunction and making ITT hold that meeting in May.
Yeah.
Why were they allowed to do that?
To delay.
Yeah. Like,
See, in Australia, you wouldn't be able to.
right, okay.
But in the US, I think you can. I don't know the exact. I mean, obviously they could, and they won the court case, so you can.
Yeah.
In Australia, you have to have a scheduled AGM. You have to give notice, and you can't move it. So again, we're in favour of the shareholders. The US gives the board a lot of power to defend.
This court was on that Australia is much better than US.
Yeah, much better. Much better for shareholders, but a little less exciting to teach because, to be honest, because defence isn't, we don't have many levers. Defence is a bit of a boring role here.
Yeah, that's it for me.
Yeah.
Everything's legal, everything's fair.
Yeah, it's fair here. It's fair. In the US, it's a real, I mean, you get lawyers that all they do is defence. They know defence inside out. Here we have that kind of people, but it's tactical and it's not very, but you know, for the shareholder, our model is better. And there's no doubt about it because the US is moving towards our model. I mean, poison pills are dying in the US. Okay, good one. Hilton's internal analysis actually valued ITT at $65 to $70 a share. Why might Hilton have started bidding at $55 and being willing to wait for several months afterwards? There's probably a better way I could have stated that question, but anyway, they valued it at $65, $70 a share, and they knew about the arbitrages. They actually point to that. And the problem was, do we have the... So they bid 55. Obviously, does anyone have any alternative view other than to say, you know, don't put your first offer first, and they thought they'd put in $55 and then wait with some money up their sleeve? Was there any other reason?
The stock was at like 43 at the time, so
Yeah, it was a 30% premium.
premiums and market price.
But if you read that, I don't even know where they got that internal memo from, but the internal memo actually recommends they should have bid $65 to 70 first up because of the ARBs. So they knew what was coming and they were correct. But you know what probably happened? The management team would have gone in and said $65 to $70 and then the board would have overruled them. Probably. That's what happened. And the board said, let's go in low and give ourselves some flexibility to up the bid later on. Okay, because look at this. Look at what happened. So there's the offer at $55, and look what happened. Day one, $58. So day one, the market said you're not going to get it for 55. So immediately, Hilton made a tactical error because the market immediately said you've got to pay more. So immediately Hilton would have been on the back foot with the market saying you've got to pay more for this. That's a classic negative, remember from last week, negative arb spread or negative trading spread. There it is there. They offered $55, it immediately went to $57. Now what does that mean? Hilton had judged that there were no competitors. The market decided differently. The market said either you've got to pay more or there's somebody else coming in, and the market was right and Hilton was wrong. In their internal memo, they said there were no competitors, but there ended up being, as we know, it went to Starwood. So they were wrong about that. In its internal analysis, Hilton considered the reaction of ARBs. To detail some of these considerations, how did ARBs actually react to Hilton's lower bid, and what action did it push Hilton towards in response? There it is there. And the reaction was they kept raising their bid. So